Alright, a very good morning trading reps and clients. Welcome to Phillip Securities Research Weekly Market Outlook. I'm Waywen. I'll take you through the market outlook for this week, followed by Ken, who will take you through our Singapore equity strategy. At this juncture, we are at the midpoint of 2013. So just a brief recap. For the first half of 2013, what we've actually seen is that the US and Japan economies actually outperforming, right? In terms of markets-wise, we also see that their respective equity indices, which is the S&P 500 as well as the Nikkei, outperforming its peers in emerging markets. So looking ahead in the second half of this year, at least for July, what we think is that notwithstanding the volatile periods that we saw in markets in recent times, in both equities and treasuries, we think that clients could position themselves to actually fit the odds of an abrupt rate hike, as essentially we might be near the end of risk repricing. Now, over the weekend, what we saw is that Fed Governor Jeremy Stein actually explicitly mentioning that September could actually be the date where tapering of QE asset purchases begin. And last week's FOMC, we also saw that the Fed attempting to manage markets' expectations by actually indicating that the scaling back of these large-scale asset purchases would be contingent on the macro outlook rather than a calendar date per se. So in essence, we might be near the end of this risk repricing that we saw in treasuries as well as equities, right? The second part of it would be that, as in the back of everyone's minds, would actually be whether have we seen a bottom in Chinese markets. We think that it's unlikely, right? Reason being that deleveraging in the banking sector is set to continue and is largely policy driven. So why is this time different? This time is different insofar because that there won't be any massive policy cushion. In fact, President Xi Jinping over the weekend mentioned that growth will not be the main priority, right? And just a brief recap, the target for China's growth this year will actually be 7.5%, and we think that odds are to the downside, given that a tighter credit situation as well as deleveraging, and a focus on more structural reforms. Looking ahead, risk could be that some state-owned enterprises could actually come underwater due to excess capacity as well as tighter liquidity. Nonetheless, we reckon that compelling valuations for China equities at this juncture makes it an attractive medium-term to long-term play. Right. Moving on to market indices. For the US, the S&P 500 is struggling to clear above the 50-day moving average level, which is the blue line here. Should it clear above this level in the sessions ahead, that would be the key support level. For the Nikkei, consistent with what we have guided last week, we're actually seeing signs of an end of a corrective wave. Right. Next resistance will actually be your 50-day moving average as well as the 14,000 psychological level. HSCI as well as the HSI, we think that downward bias is likely to persist, notwithstanding a bounce late last week, largely due to the concerns that we have on the Chinese economy that we mentioned in our first slide, as well as from a technical charts point of view, right? So for instance, from a technical point of view, the HSI forms a bearish head and shoulder, classic pattern, right? And markets are actually closed today, and we need to see what happens in the following session from tomorrow to see if there's a rebound is imminent. For STI, really notwithstanding the bounce last week, it needs to clear above your 3230 level to actually climb higher, and we are cautiously optimistic of that possibility happening. For the Stock Exchange of Thailand, essentially struggling to clear above its 200-day moving average, which is your blue line here, right? And key support is pegged at 1,400 level. For the Jakarta Composite Index, it's interesting because as you have noticed, we saw a sell-off, right? Especially when there's a fuel price hike, but markets start to rebound subsequently. Now, why is this so? Because essentially, a scale back in fuel price subsidies is painful, but markets recognize it's also a necessary step ahead for the economy, and hence, we are still overweight Indonesia, and we are optimistic about the Jakarta Composite Index. For the KLCI, it's consolidating. A key point to note is that it actually broke below the low of this candle, your post-election candle, right? But nonetheless, it still managed to stay ahead, consolidates, and at this juncture is the most resilient ASEAN index. But we caution that our momentum is actually easing, right? With that, I'll pass on to Ken, who will take us through our Singapore equity strategy.
Hi everyone, this is Ken here. So on this, we recently issued our Singapore strategy report on the 18th of June. What I'm going to say is a summary of what we have written in the report. So on these sectors, on industrials, we are positive, especially for companies in the niche areas. This would include one of our top picks, Pan United. On commodities, we are slightly cautious because we see continued CPO price pressures. For telcos, we prefer them over the REITs because they offer growth with yield as compared to the REITs in which it's mostly on yield. For REITs, we will recommend bottom picking. For the property, we see some pressure because we expect a huge increase in supply moving forward of approximately 100,000 units, and this huge supply is likely to cause some downward pressure on property prices. On banks, we are cautiously optimistic as the banks have guided for margins to stabilize, and also the only concern would be that once interest rates increase, credit costs may become a problem, but however the increase in interest income is likely to mitigate this credit cost increase. Okay, so on Singapore, 3 topics. That would be the first would be Singapore Exchange Limited. The second would be Pan United, and the third Keppel Corp. Since we have talked about Pan United quite extensively 2 weeks back, we'll focus more on SGX and Keppel Corp today. So on SGX, this is a very quick snapshot of the company. Right now, prices have gone down to $7.03. Today, I believe right now it's trading around $7.01. Okay, so on SGX, it's a monopoly of Singapore's exchange business, and it's the largest offshore venue for Asian equity derivatives. And as you can see over here, I'd like to highlight that equities used to make up 48% of the total revenue for SGX, but right now it only makes up 38% due to a drop in securities because recent trading volumes in the last year has been relatively weak. For derivatives, you can see that on the contrary, it has actually increased from 21% to a very high, much higher 28%, and has been making up for the lower performance for securities in the last couple of quarters. So why are we positive on SGX? Is because we, having had the securities been weak in the last few quarters, we actually see that we actually expect higher securities revenue moving forward, as we are seeing an increase in securities daily traded value. It has been pretty strong the last quarter, and also this quarter has been strong. In fact, in the last quarter, the total net profit actually hit a 5-year record high. Besides the high securities trading, we are also positive on the derivatives. It has continued to be strong and gaining strength as Asia's gateway. Third, we are also positive on the attractive dividend yield of above 3.5% approximately, which is at current prices is around 3.8%. And also on top of the attractive dividend, there's strong free cash flow and special dividend potential could emerge with continued good performance for SGX. So on higher securities revenue once again, you could see that on the third quarter, we actually saw a 41% increase quarter on quarter to 1.71 billion in terms of SDAV. And we continue to see improving market sentiment and also increasing trade. This is as we see that globally we see a shift from of funds from bonds towards equities, and SGX would stand to gain from this higher interest in equity. On derivatives, you can see over here that the increase has been very interesting. It has been very strong, and this is mostly led by the this is our fourth quarter estimate, and we actually expect that on a Q&Q basis there may be even a higher increase. This is because we see continued interest in four key futures. That would be the Nikkei 225, the China A50, the MSCI Taiwan, and the China A50. And these four have been driving the increase in DDAV very strongly. So just on others, very quickly, there's growth has been quite okay, and expenses have been well managed. Key risks would include share price decreasing in line with the broader STI. However, we expect SGX to outperform the market, the broader STI. Okay, and lastly on valuations, once again before we go into that, we would like to highlight once again the three key points, which is higher securities revenue, stronger derivatives revenue, and attractive dividend yield above 3.5%. And we actually have a accumulate rating with a target price of $8. On Pan United, since we have gone through this stock, we will cover it very quickly. Right, current price is at around share price as of 28 was 90 cents. Key main business is once again providing cement and ready-mix concrete in Singapore, and also a 51.3% stake in top 10 river port in China. Right, so the reason why we are positive on Pan United is because we see that it's able to ride on Singapore's construction boom. Second, due to the profitable port in China, and third, because of its strong value creation track record. So once again, on the SG construction boom, we see a healthy pipeline moving forward in public works as Singapore bridges the infrastructure gap. On Pan United, the key thing to highlight is first that EBITDA margins and net margins are very strong and above 20%. And second, we see a catalyst, and once again, we see a catalyst should MIIF liquidate its assets and Pan United take over it. And we see that this would be ROE accretive, and also that Pan United has the cash on hand to be able to fund most of this acquisition, and therefore dilution through equity placements is unlikely. Third, Pan United, there's also a strong history of value creation of $1.74 per share. Right, and list of BBM's major projects moving forward, you can see in 2014 it's going to be quite a bit in Singapore. Key risks includes higher China wages and weaker Chinese performance in import-export of the economy, which will lower port earnings. And we rate Pan United a buy with a target price of $1.21. So on Keppel Corp, right now share price as of 28 June was $10.40. Our target price is $12.34, and you can see over here that since its peak over here at around 11.30 plus, it has dropped to 10.40. So on Keppel Corp, one of the major components that we'll talk about today will be the O&M. Mostly it's in the they actually do drill rigs. That will include your jackup rigs and also your semi-subs. Jackups would be for shallow waters, whereas semi-subs would be for deep water. So the reasons why you're positive on Keppel Corp is because of three reasons. First, on higher margins. This would be from repeat orders resulting in efficiencies for the jackup rigs order. Second, we see strong order book wins. Year to date, it's been 3.1 billion, and we expect this to continue. Right, and third, that would be attractive dividend yield of 4.4%. And Another positive would be that this attractive dividend yield, there is visibility till 2019 because of the strong order book wins currently. So on higher margins, we can see over here that the KFL B-class designs actually make up 19 of 30 jackup rigs, and you can see on the first column, the third and fourth column, most of these are actually based on the KFL B-class designs. And with these repeat orders, we actually are seeing a higher margin for Keppel Corp. Second, strong order book wins. Year to date is 3.1, and in fact, as of first quarter of this year, we actually saw net order book record high of 13.1 billion, and we expect that moving forward, we expect to see higher revenue growth as increase in order book wins possibly from semi-subs. This is because we expect that the global deep water market capex is expected to increase, and right now the semi-subs utilization rates are already very high at around 95%. Also, we see a robust offshore and marine outlook as long as oil prices are expected to remain in a healthy range of $80 to $100 US per barrel. And also, Keppel Corp continues to have a competitive advantage over Chinese peers because of better track record. Right? And key risk would be that should oil prices decrease substantially, this may affect the attractiveness of building drill rigs. So with that, the three key points would be higher margins, strong order book wins, and attractive dividend yield of 4.4%. And based on our and we have an accumulate rating with a target price of $12.34. With that, these are some other counters that you might be interested in. Questions? Okay, we have a question on the floor on why we cease coverage on SIAEC, whether or not there are fundamental concerns with SIAEC. Actually, for SIAEC, the reason was because we are currently experiencing a change of analyst, and we continue to see positives on SIAEC, and that we do not see any fundamental concerns. And once the change of analyst has been completed, we would continue to cover SIAEC.
Hello. With regards to your question on shale gas, well, in the near term, shale gas, the impact of shale gas on oil price will be pretty much insignificant. But in the long run, it's still we should say it's still it might be a concern in the long term. But currently, at this point of time, shale gas is still in the infancy stage, so it shouldn't have any impact on oil price in the near term.
Okay, there's a question on whether that the SGX chart seems to be pointing down, and could there be further retracement in its price? On this, we see a resistance at the $7 level, but we are positive because we actually expect that this the upcoming that for the upcoming results, we actually expect to see a nice earnings surprise, given that in the last 3 months we actually seeing an increase in we saw a continued increase in securities trading value. That's one, and two, derivatives have also remained strong, and this too is likely to lead to a nice surprise in the earnings for SGX, and this could lead to this is what we expect to lead to better share price performance. And also on the shift, a question would be that that we mentioned a shift from bonds towards equities, and that that the person asking has highlighted that in the US, funds are moving out of both bonds and equities. So in the case of Asia, and how we reconcile this. Actually, what we are seeing right now is that we are seeing that funds are moving out of bonds towards developed market equities, including that in the US. Yeah. And that we expect that in long run, we expect, or rather medium term, we expect that we'll expect a continued shift of funds away from the bond funds towards equity funds.
Okay. All right, with one question on how low we think the STI correction could actually go. Now, if you look at this chart right here, what we are seeing is that the STI has actually bounced up above the 3,100 level, right? It's often very tricky to pick bottoms, but I think we reckon that this week we could actually see a couple of key risk events that could actually make or break the STI. First of which would actually be the ISM numbers from the US, right? That will give us a picture of the health in the US economy, followed by the ECB, right? The ECB will actually meet this week. Now, should the ECB actually hint of that they would even consider tapering just like the Fed, then we might actually see some sell-off. But our base case is that the ECB will actually reassure markets that say, look here, we would ensure that monetary policy conditions remain accommodative, and hence there should be no signs of tapering from the ECB. So in short, key risk events this week will actually dictate the direction for the STI.
Hi. With regards to the issue on competition from the Korean yachts, yes. Well, the Korean yachts are coming into the jack-up segment as well, due to the fact that they have lower backlogs due to the lower orders for their vessels. But having said that, Singapore yachts are still strong in terms of their proprietary jack-up rig design, and for Keppel, the proprietary KFLB class design is like a standard benchmark for the offshore marine jack-up market. So yes, competition is there, but they are still holding on their turf well, and in fact their prices are, the jack-up rig prices are still hovering above $200 million per rig. So right now, at this point of time, we still see fundamentally Keppel as a good stock to hold. Thanks.
Hello, Joshua here, Head of Research. Okay, so we have a question on why is Amara out of our list? Well, that's because the strategy report was written before the Amara report was out. So Amara could very well enter the list in the next report, and we intend for these strategy reports to be updated on a monthly basis. Now, what is your view on, another question, what is your view on Bowser's announcement last Friday on its new subsidiaries incorporation for possible REIT structure? Yes, this is, sorry if I was too soft just now. Yes, this is positive for Bowsted. All the properties are presently booked at cost, right? So a REIT structure would definitely unlock the value. And they have no, they have not called an analyst briefing yet to explain to us on any timeline of plans, but this has been on their mind for quite a while now, and I think they've taken the first steps to do it, and we will definitely update investors as we go along. At the present price anyway, Bowsted is, I think, represents quite good value. On a forward basis, it's about 10 times earnings, and it's paying good dividends, 7 to 8 cents. And going forward, actually, although there is some weakness in its real estate, industrial real estate turnkey order book, there is a surge in orders for its energy business, right? So its energy business is in the refining sector, and there is a boost to its order books because of the shale gas boom, and also capex upgrades and renewals around the world. And we see margin expansion there, and there has been a surge of orders there, and we expect this to offset the weakness in the industrial turnkey segment. Okay, I'll move you on to the next speaker question. Hold on.
Hi, there's a question on why Amara wasn't on the list just now. We actually have we are definitely going to include it moving forward in the list of Amara. Would be one of the counters that we would that we actually recommend for investors to look at. Yeah, just that we have not included yet, but we are going to.
All right. We have one question on long-term interest rates. So the question is, long-term interest rates seem to be rising in the US. Do we think it's sustainable? Right. So the thing is that our base case has always been that for US Treasury yield to actually bear steepen. So what that means is that our base case has always been that for the US Treasuries, 10-year yields to 30-year yields to actually creep up much higher. Okay, that has been our view since late last year. The reason being is that it is inevitable given that the US economy picks up steam. And whether we think it's sustainable, yes, we think that yields will continue to actually creep up higher. But there must be a distinction drawn between yields creeping up higher versus yields actually being volatile. What markets don't like is actually volatile yields, right? So on the second part of the question is, do we actually foresee the short-term interest rate moving up in the near term and the rates movement in Singapore? I think for Singapore-wise, SIBOR is still relatively benign, right? It's just that for Singapore, what we are seeing is that our 10-year yields, right, actually creeping up much higher in tandem to what we actually see for US Treasury's 10-year yield. Reason being is that Singapore actually takes on an exchange rate policy, right? So if you look at it from an impossible of Trinity condition, interest rates movements in Singapore, by and large, will follow the US ones, especially at the long end, consistent with what we're actually observing right now. With that, I'll pass on to the next speaker.
With regards to your question on Keppel TNT, I guess We don't really consider Keppel TNT as a good proxy for Keppel Corp, as they both give, okay, as this is because Keppel TNT gives a different exposure in terms of the industry. Keppel TNT is in the logistic and telecommunication industry, which is somewhat different from Keppel Corp, where most of its revenue is generated from its offshore marine segment, as well as the property segment. Even though there are still small portion that comes from Keppel TNT itself, but we don't consider Keppel TNT as a good proxy for Keppel Corp. Thanks.
Hi, we have a question on Sabana REIT and also on Comfort Delgro. Unfortunately, due to a change in analyst coverage, we currently do not have coverage on these two counters.
Hi, Lucas speaking here. There's a question on the property REIT sector saying, asking why is it that we do not deem 5 to 7% current yields still, why do we think that it's still unattractive? The main reasons that during a correction, normally the REITs will reach to higher levels before they actually we go back to the norm of between 5 to 7%. So we believe that the market may correct further, and that would present a better chance to go in then and not now. But the yields currently is still reasonable. If you guys are still hunting for certain counters, do look for the yields that is on a higher end of sites, because those are REITs that have really corrected. Yep. Okay, we have another question regarding the REITs, saying if the interest rate were to increase, what will be our view on the REITs prices? We believe that the REITs price will actually come down if suppose there is increase in interest rate. The reason is because the hunt for the required returns will be higher, so people will price the current REITs, the REITs at a lower value. So we feel that there may be a slight correction, although it's not perfect
it's not a perfect correlation. We believe there will be some correction if interest rate were to increase. Yep.
Alright, in terms of the question on how low we think the Shanghai Composite Index will go, at this juncture, what we are seeing is that near-term downward bias will actually likely persist for Shanghai Composite, right? In view of the concerns that we have on the Chinese economy that we expressed on the first slide just now. Also, when we look at markets when they open this morning, at this juncture, it's struggling to clear above the 2000 level, and there seems to be, from a technical setup, a bearish pin bar. So in short, we think that downward bias will still likely persist for the Shanghai Composite.
Hi, I have a question asking for our view on last week's cooling measure on property stocks. We believe that this cooling measure is actually referring to the tightening of the how the bank can actually lend to the individuals, and yeah. But our view is that this is actually more of a fine tuning. The majority of the previous property measures are more drastic, and this is actually more fine tuning, so that it's actually those buyers will be more of the core buyers, those that actually buying for their own stay. In terms of investment wise, you realize that this will price quite a few investors going for a second and third property out of the market. So there will be an effect. The stocks will actually, for the correction, will actually react to it, but we do not believe that the correction will be very drastic. So yeah, quite muted response to such property cooling measures as of now. Yep.
Hi, I have a question on the banks. And the question would be that with the coming increase in interest rates, will it benefit the banks like DBS? And what would my take on this, given that we have a neutral rating on DBS? Okay, so as a history, right, we actually downgraded DBS from accumulate to neutral during the last result season, as we and since then, actually, the bank, DBS and UOB, which both downgraded, have actually gone down quite substantially. Moving forward, we're actually cautiously optimistic on the banks, and we're looking to upgrade it once there's more visibility and valuations are compelling. And yes, the banks would expected to benefit from increased interest rate, because an increase in interest rate is likely to increase your interest income for all your loans. Right, and however, one thing is that once again, we have to watch out for the credit cost, which is the amount that the banks would lose due to provisions and increase in bad loans. That said, we expect to see overall increase in net profits should when the interest rate increase come in.
We have a question on how would the slowdown in the Chinese market actually affect the Singapore market. I think from a market point of view, there seems to be some decoupling. I'm not sure if there's even a link in the first place. Because at this juncture, what you're seeing right now is that although that the Shanghai Composite has continued to trend lower, the STI has continued to bounce up, right? So that's from a market perspective. From an economic point of view, the thing about Singapore economy is that a lot of its final demand actually comes from the US and EU, which is your developed markets, right? And right now, in the second half of this year, we expect the US economy to actually continue to outperform, right, versus your Chinese economy, China. So on balance, that actually bodes well for the Singapore market and the Singapore economy.
There's a question on whether other than Courts Asia, we have coverage on any other consumer services related that we're looking at that have low debt and can ride on the consumption trend theme. Right now, unfortunately, among our the companies with better valuations, it would remain as Courts Asia. And why we like Courts Asia once again would be that because of the we see high growth potential, especially as it expands more into Indonesia. It's expected to launch its first Indonesian mega store soon in around FY in calendar year around 2015. And also we see that Courts have a very unique position because it offers credit facilities to its customers, an in-house credit facility, and this allows it to draw big different target markets. That being the lower income lower but sustainable income households, and also the other households which are able to pay who prefer to pay directly 100% on cash. I have a question on Singtel on the unsuccessful tender for the Myanmar telco. Actually, on this tender for Myanmar telco, they have not won the license in Myanmar, and we are actually slightly positive on this. That being that this Myanmar venture is likely to take up a lot of capex, capital expenditure, and that right now they are the Myanmar government has actually said that they want to have relatively high coverage, have relatively high coverage to provide relatively high coverage in Myanmar, and this is likely going to cost quite a bit in terms of capex, and also that the revenue is not very visible in Myanmar, given that it might be quite hard to estimate penetration rates for the mobile segment, and therefore, given that they're not in Myanmar, although there may be slight loss in growth opportunities in the long term, but but this lack of participation has actually could potentially lead to higher ability for Singtel to pay special dividends in the midterm. And also, Singtel can continue to participate as subcontractors in installing the various communication devices in Myanmar. We have a few questions on REITs in SGX and which one are better, and also any news on the SPH REIT IPO. Unfortunately, we do not have coverage on this as we are currently experiencing once again a change of analysts. Okay, thanks everyone. Since there are no further questions, we would like to end here. Thanks once again, and we will hope that you tune in again next week. Thank you.